Let's have a look at this set of notes. All right, the first bit is obviously a recap. How do we derive value from a derivative? We need to look at the underlying. Okay, the underlying actually gives us a guide in terms of what the actual value is. Okay, and we can have a derivative for different things. Equity derivatives, currency derivatives, bonds, indices, commodities. There could be lots of different types of underlying assets. Okay, right, last week we spoke about a call. Okay, so remember, a call is to have the right to buy. If I have the right to buy, if the price had to rise, I'll be in profit. If it had to fall, my loss will be capped to the premium. Okay, so the key is the strike or the exercise price, because that's the price at which you can exercise this option. Okay, so that carries a certain level of risk, because if the price is very high, very low, it's obviously going to affect the option in terms of value, depending on what the actual asset is. Okay. Then we also looked at a put, which is the opposite, the right to sell something. Here, I want the price to fall. Okay, so the underlying asset needs to actually reduce in price or value. If it does, this particular derivative will derive more value. Okay, it'll be worth more. Okay. All right, so looking at the put-call parity again, what does the put-call parity represent? It represents the put, okay, in relation to the call. All right, and do you agree the one is the opposite of the other? Okay, the right to sell and the right to buy, they're both similar. And if I've got the same underlying asset, they should be priced the same. Why do we price them the same? Or similar. Why do we base the one off the other? It's to avoid arbitrage. Okay, you don't want a put that's mispriced in terms of its call. Okay, if it's the same product in terms of underlying and it's a derivative being the option, it should be based on a price that's similar in terms of puts being equal to the calls. Okay, right, so if we price an option,
do we have to go into another synthetic puts or synthetic options? No, we do the parity we say fiduciary call versus the protective put, and then
I don't think I've seen any questions covering that. Okay, but we'll look at past papers again and we'll see. I don't think so. Okay. All right. So what happens if this information is not available? Yes. Correct. Okay, so that's why we have these models. Okay, the reason why we have them is to price options when there isn't sufficient information. Okay, so an easier way of pricing options would be to consider the stats, okay, because this is all based on probability. Okay, so what will happen if the price is to rise or fall? What is the actual option going to be worth? Okay, so there's two methods, discrete and continuous, and then the other, which is the black. Okay, so let's look at the first, the discrete method. Okay, if something is discrete, yes, okay, continuous would be time. Time is continuous, okay, or let's say, continuous data, so time would be height, or so like there's the data is, there's a range of values, okay, that's continuous, okay, rather than discrete where, so for example, a discrete variable would be male or female, that's discrete, okay, or single or married, or what else? Discrete, where true or false, that's a discrete variable. Okay, heads or tails, that's a discrete variable. Okay. Alright, so a binomial model, okay, we're looking at the simplest model that can be used to price American options. Okay, American options can expire anytime. Okay, you can exercise that option at any time. Okay, so when looking at a one-paired binomial model, a binomial, okay, model has two possible events. Okay, so they always talk about a plus, a C plus, and a C minus. The plus is for an increase in the underlying. The minus is for a decrease in the underlying. Okay, so here we've got two equations. C plus, which is the call. The call when there's an increase in price versus the call with a decrease in price. Okay, we've got the maximum of the spot all right, with the price increase minus the exercise price. Okay, U is representing up. Okay, D is representing down. Okay, so how do I get the U and the D? I use that formula. Okay, H is the hedge ratio, which is the N S minus the C. Okay, so the N times the S minus the C gives you this hedge ratio. Okay, the hedge ratio is important to know. That I have seen come up in past papers. So just to define it for you, if you look at the glossary always gives you a list of terms that you should be familiar with. Okay, so if you look at page, hedge, there's it, on page 638. Okay, hedge ratio. The relationship of the quantity of an asset being hedged to the quantity of the derivative used for hedging. Okay, so we're looking at a relationship between the two. Quantity of the asset being hedged versus the quantity of the derivative used for the hedging. Okay, the next bit, I've circled these because they're important. Okay, obviously in the exam you're going to have a formula sheet. You'd have to use these formulas to work out the correct pricing, okay, for that particular option. Okay, so N here, how do I get N? It's obviously the C with the plus, so the call with the plus minus the call with the minus over the S, okay, which is the spot. X is the strike, okay. S is the spot, so S with the increase and S with the decrease. Okay, that gives you what? The N for the hedge ratio. Okay, then you've got those equations looking at risk-free and this. What is that? That's a variable representing the risk-neutral probabilities. Okay, so what is the probability of the one, okay, versus the probability of the other? Okay, because an option can go up or an option can go down. So we're looking at what is the probability of that happening versus what's the probability of that happening. Okay. Right, so here's an example. Suppose the underlying is valued at 50. Okay, the expectation is an increase of 25% or a decline of 20%. Assume a risk-free rate of 7%. Okay, so I need my up and my down. Okay, so what is up? There's it. It's the price increase over the price now. So what is the price now? 50. If the price increases, what will happen? It will increase by how much? 25%. So what's 50 times 1.125? 1.25, yes. 6. Okay. And then you divide that by what? Yes. Correct. Okay. Alright, and then obviously the down would be the same thing except the price decreasing. So the price will decline by how much? 20%. So take off 20% is 0.8. So 50 times 0.8 divided by 50. Yeah, that's just coincidence. Okay, so now I need the C plus. The C plus is an equation over here. Okay, there's the C plus. Right, and there's the C minus. Okay, so if I look at the C plus, I'm looking at the maximum, okay, of 0, 50, okay, minus that. Because remember, this is what? Spot minus strike. Okay, so what do you want? You want the price to rise. So if the price rises, what's the maximum that you could get? There's it. Okay, so that's the maximum value for what? The call. Okay. Okay, that's the C plus.
So the greater of 0 or 12.5.
Yes, the greater of 0. Because remember, calls are limited to 0. Okay, you can't have a negative value. Okay, so if it's not the other amount, it must be 0. Okay, and then C minus, the opposite. Okay. No. Is it?
There you go.
Okay, it's the minus.
Right.
Yeah, same thing. Same thing as before. It's just the plus and the minus. Okay. Right, so I'm just using the other amount, which was the 20%. Okay, because I'm taking it off, I'm not adding it back. Okay, and then you get a negative. Can you have negative? No, so you'll have 0. You're going to take your time, make sure you've got the right working. Okay.
So it's limited to 0.
Yes, so C minus, so what is the call price with a decrease in value of the underlying norms? Okay.
So then your loss would be where you paid.
Your loss would be what you paid for that, yes, okay. Alright, so now I need N and I need C, okay, and you've now worked out C plus and C minus. So can I work out N? Yes, okay, so if you substitute what we've worked out earlier, what is N? Yes, that's the price increase. No, 0.555. Okay, you're using the financial. You should rather use the scientific.
I'm going to go to my bag, but I'm so used to this 22.5.
Okay. Because the scientific, you can put brackets, you can put brackets, you can put decimals, fractions, all of that. So.
Yes, you got it. It's just
Okay.
I punched the bar, yeah.
Okay.
So,
Right, but are we happy with that 0.55?
that makes sense.
All right. So now I need the C. Okay. But before I can get the C, what do I need? I need the pi. Okay. So the pi symbol is 1 plus r minus d over u minus d. Okay. Do I have d and u? Yes, I do. Okay, so what is the r? Yes. Okay, so 1 plus 0.07 minus 0.8 divided by 1.125 minus 0.8. It's a lot of mathematics. It's find amount substituting. Find amount substituting.
That's okay. That's okay.
It's not, yeah, it's just the formulas, yeah. Yeah, and what do you get? Yeah, you can, but it's a little bit more, yeah, you don't see what's in the actual memory. If you could see what's in the memory, then that helps a lot. Yeah, no, that's good. It is a nice fancy calculator to play with, so you can see why it's 0.6 is correct, yes. Okay, now what do I do?
Now you take that pi into the C form.
Correct. With all the other variables. Okay, let's see what you get as the call, because now I'm working out the C. So it's a bit of simultaneous equations, basically. Okay, it's up to you how you do it, but yeah, as long as you get to the right answer, then that's great. Okay. Yes, good.
I'm just looking at see why I'm doing on the end because it's always going to be 0. 1 minus 5.
Well, in this case, it's a 0, but not always.
Oh, okay.
Okay, because a 20% decrease in the underlying gives this call no value.
So it could be 5%.
If it was 5%, then you might have value. Okay.
So that's what this call option is.
That's what it should be priced at.
So
Yes.
in the market, that's no arbitrage. If it was different.
Correct.
Then it would be arbitrage.
Possibly.
Buy and sell.
Sure. That's right. Yeah. Okay. Alright, so if we have a two-period binomial model, okay, again, binomial means two events. So here we've got up and we've got down again. Okay, this is a tree diagram. Okay, what is a tree diagram? It's different events. Outcome 1, outcome 2. Okay, then outcome 1, outcome 2. Outcome 1, outcome 2. So that's the first tree, that's the second level. Okay, level 1, level 2. Okay, but two different branches, if that makes sense. Okay, so now here I'm looking at increases and decreases of increases and decreases, if that makes sense. Okay, right, because if I do this, I'll have a plus here, I'll have a minus there. Then I could have a plus here and a minus there. I could have a plus here and a minus there. So what eventualities can I get? I can get a double plus, I can get a plus minus, I can get a minus plus, or I can get a minus minus. Okay, those are the possible outcomes because of it's a binomial distribution. Okay, well, not distribution specifically, but it's a binomial event. Okay, where we've got these two separate considerations. Okay, so again, more formulas. Okay, pluses and minuses and minuses and minuses. Okay, so if I look at this, okay, here's the C double plus, here's the C plus minus. Is the C plus minus the same as the C minus plus? Yes. Okay. All right. And then here, okay, Excel hasn't put a gap in between, but it's a C minus minus. Okay, a minus minus. Yeah, it's just put one line. Yeah, I should have maybe put a gap in between. Let's see if I can quickly do that. Yeah, there we go, little gap. Okay, but then, all right, there we go. Save. Okay, so that's the C minus minus. That's how you would work it out. Okay, so we first need the up and down again. Okay, then you've got all these fancy equations. Right, very similar to what we had before, but now you've got two because it's n plus and n minus. Okay, so the n can go up, the n can go down. There's two. It's binomial. Okay, so you'll have two of these workings. Okay, and this is what I need, which is the call price. Okay, that's the call. After having gone through all of that, okay, this is like simultaneous equations, hectic simultaneous equations, okay, where one gets referenced in another, gets referenced in another, gets referenced in another. Okay, but just take it step by step. Okay, start with the easy, get values for each of them, then substitute in that. Okay.
So you need to go in that order, so you get the up, get the down, get the ends, go to the C.
Correct. Exactly. Yeah. So
over to a pi first, and then back to that, and then
the last step is the last step is that. So you would have to just put down all the equations on a page, like I've done there, and then just plug in what you've got, and then do it mathematically. Okay. All right. So with discrete, here's the note. Okay. I'm looking at what? Probability. Okay. So there's a probability that the price can go up in terms of the call, and the call can go down. Okay. And yes, okay, down again and or plus, depending on the situation. Okay, so when looking at the discrete time, okay, binomial model, page 200, it's the simplest model that can be used for pricing American options. Okay, we know we're pricing options. Why American and not European? Exactly. Yeah, it's only at expiry. Right, so in this particular example, we need to draw a tree. Okay, so that's the tree. Right, let's have a... No. I haven't seen any questions. Yeah, that no. Okay, yeah. I would have remembered definitely if there were trees. There aren't any trees. Yeah. Did you send through current exams yet? Or do they not give you current exams? For this one, yeah. Okay, so everything's online. So they really okay. So there's no past papers that,
There's just those 2014, 20.
yeah, the much older ones. Yeah, but I think I've even got most of them, or all of them. Yeah.
There's
Okay.
no
Yeah.
current, because we actually write online.
Okay, so
I don't know, I'm scared.
that's a pity.
I'm actually scared to.
But you've got all your books, you've got all your notes.
I
You should be
know,
like fine.
that's
That
the
should be a piece of
worst.
cake.
Yeah, but that's the worst, because now you've got the stuff there. And you
But then
can't
it's
waste time.
no, you won't waste time. You need to prepare for the exam, because exams like this will have a formula sheet. Okay, if you write any like mathematical type of question like this, it either has to be open book or they have to give you a formula
I
sheet.
just
Yeah.
have to make my own formulation.
No, you can use the notes. The notes have everything you need. So
Yeah.
I would, yeah. So when we do, yeah, because as I said, when I did the past papers previously, we used the notes as our formula sheet.
Okay.
Okay, and we just,
Then I'm just going to do
Yeah.
that, and I'm going to
Yeah.
go with that, because, as I say, it's, yeah, so, everything's there.
Yes.
And I think I've got OCD like that.
Oh.
Question, I'm going to go check it.
Okay.
You've got time, and then you fix it
Yeah.
out.
Well, do everything that you're comfortable with, and then if there's anything that you need to like page through, then just skip it and then go hunt for it. Yeah. Okay. But then use the index. That's the easiest way of doing it. Okay. Like now, yeah.
At the back, they give you all the formulas as well.
They do. It's a very theoretical,
Analysis versus.
not theoretical. It's a very calculation focused.
They give you all the formulas as well.
Yeah. So even maybe just use that then. Yeah. Okay. All right. So what is this looking at? Continuous. Okay. Continuous time. All right. So if something is continuous, correct. Okay. There's no clear start or end. Okay. It's continuous. Right. So what do we use here? We use the Black-Scholes-Merton model. All right. So this is used for continuous compounding. Okay. You should be familiar with that from previous modules. What is continuous compounding? It's when I make the period so small, it's literally an infinite number of periods. Okay, not months, not quarters, but infinite. Okay, right, so the variables, what does the S0 represent? Yes, and the X? And the R? Okay, good. No, continuous rate. It's continuous compounding. RC. Is it still risk-free? What do you mean still risk-free?
They use the risk-free rates earlier.
In terms of discounting, it should be. Let's check.
I just didn't know if they carry out.
Yeah, let's check. Oh, let's go open up that chapter. Okay, so it's chapter 4. No, not 4. It is 4. Yeah, sorry, that is right chapter. Okay, so let's check that. The RC is. Okay, so yeah, so it's continuously compound and it's the risk-free rate. Yes. Okay. All right. Okay. Yeah. Okay, I think you're looking at the foreign rate and local rate. That's something different. That was actually one of the questions in your assignment. Okay. All right. So, what is the C? The call, and the P? The put. Okay, and that's how you measure them. Again, before I can work out the put and the call, I need these variables, the D and the D2. Okay, all right, so what is this? No, it's squared, so it's variance. Yeah, if it's on its own, it's the standard deviation. Standard deviation squared is variance. Okay. Okay. Well, you see it a lot, eh? It came up in other modules as well. Yes. Okay, so do you know how to use the stats normal distribution tables?
Never used it in my life.
Serious? But didn't you do STA?
I didn't have to do STA.
Oh, you didn't do it. But you say you have done stats.
We had to do
economics.
Yeah, economics.
Okay, so you've never used the normal distribution tables in terms of finding a value for, they call it let me think now what the right word is. A Z value, that's it, Z value. Z values and T distributions. Have you not done that? Okay.
We did have to do QMI.
Okay. Yeah, but that was maths and some finance, yeah. Okay.
We didn't have to do that.
Alright, interesting. Okay. Alright, so let's look at this then I'll show you how to use the tables. So let's first I hope the tables are in here because I remember I had to bring a stats book. Yeah, because when I did this with Michelle a few semesters back, I had to bring a stats book to show her the tables. So I don't know if I have to do the same for you. Unless they give it to you in here. I can't remember if it was here or not. If they don't give it to you, then we'll use a past paper. Because the past paper will definitely have it. Okay, let me use the past paper because you'll have it in the exam anyway. Oh no, you won't have it in the exam. That's a good point. Okay, so yeah, sure, they've changed it quite a bit. No more written. I think written probably would have been better, or not. Where did you see the table then? Because I remember having. Oh, here's it. 243.
Yeah.
Okay, I also see it now.
This table I haven't used.
Okay, so you know how to use it. Why did you say you didn't?
When you call it a stats normal distribution of.
That's what it is. Yeah, it's a bell curve.
Yes, we in economics we derive a bell curve.
Yes, because you use it to work out the area on this side or the area of the tails, and then you get the z value and stuff. Okay, I don't know the economics application. Okay, I know this application. Okay. All right, sure. That sounds hectic. Okay, that sounds hectic. That I don't know what you're talking about there in terms of economics. Okay. Right. Okay, but yeah, I know what this means, but not in relation to economics. Okay.
No, I know it in economics and I don't know it in that.
Okay, but yeah, we'll join the dots. Okay, so here's the example. Calculate the European call. If it's a European call, describe it.
You can exercise it opening this file.
And what right is it?
It's a right to buy.
Okay.
No.
Yes. At what price?
68.
So what is that?
So that's this file.
That's the X. No. Yes.
No. Is that the X? Yeah, it's X.
No. Hold on. Calculate. Oh no. It is the S. Okay. It's the underlying price. It's the spot. Okay. The exercise price. It's there. That's the exercise price. Yes. Okay. Continuous compounding risk-free 4%. Option expires in 110 days. Okay. And the volatility, which is the standard deviation, is 0.38. Okay. So it's not often that you need to work this out. You can work it out and you would have to use the stats calculator. But I don't think they're going to ask you to do that because then they need to give you a table of values. Okay. All right. So what's the first step? Get the D. Okay. Because remember, I'm working out what here? Call or a put? Yes. So this is what I'm looking at. But I still need the D and I still need the D2. Okay. The N is that normal distribution thing.
Yeah, the table.
Yes, the table value. Good. Okay. All right. So the first step is to plug all of what we just identified into that.
So D is being the first probability. D1 first probability.
D1, D2. Yeah, D1 and D2 refer to those amounts of distribution, basically. Yeah, we'll look at that just now. Okay, so what is that amount? So can you work that out?
I can, but it's really easy.
Okay, try and let's see if you get the right answer. Okay. I don't think that's a good idea. I don't think that financial calculator is going to be. I don't know how you're going to do a lin on that calculator. That you should know. Sure, but to do lin with all of that, yeah, but the sharp is probably going to be easier. Second function lin, it should be on one of the buttons. It should be in orange, I think. Okay,
Okay.
then shift or
Let's see. Okay, just straight in.
okay, you don't have to shift. What are you thinking?
68.5.
Yeah, but remember it's a bracket within a bracket. So you need to put this in a bracket because the top is the numerator. So it's a bracket, then all of that, then a bracket with all of that. Yeah.
Just work out the top.
Oh, okay, that's fine. Okay, okay, do it that way, and then you'll get a value for the top, and then work out a value for the bottom. That's also fine.
It's very
Okay. No, it's fine to do it separately. It's probably better to do it separately, and at least then you don't make a mistake somewhere. I'm surprised. The scientific calculators are good for things like this. The financial, yeah. Oh, okay. Try again. Try again. Try again. Be careful. One step at a time. Work out. Okay, work out. Learn 68,5 over 65, and write that value down there, and then write down that answer over here, whatever that is. Yes, of course you do. Of course you have to bracket it. Yeah. Okay, so it's learn bracket, then that close bracket equals. No, it shouldn't. Where's my calculator? Don't have it here. Let me use the Excel then.
Okay, if I do it backwards, I just say 68.5 divided by 65 and then I get 1.15.
Okay, but you're getting a value.
I am.
Okay, so let's do it here.
Interesting to why it doesn't like this. Does it have to be second?
No, it shouldn't matter. Okay, so equals ln brackets 68,5 divided by 65 is that. Yeah. No, if you use a bracket, then it's fine. Okay, then that's strange. Okay, yeah, it should be a bracket within a bracket, or maybe when you press ln, does it open a bracket? When you press ln, what do you see? That's it. Then if you open a bracket, 68.8 divided by 65, close bracket, equals. Oh no, let's see the calculator. Maybe you're using the wrong button. Using this one? Okay, that's fine. Reads brackets. That's hard. Oh, you're not putting in the right value. 68.8 you put in. Okay. 68.5 divided by 65. Yeah, it's just the number. Okay. You should try use maybe 5 or 6 even. 4 should be fine. Obviously, the more decimals you put into the calculator, the more accurate your answer will be. It's fine, as long as it's close enough. What's wrong?
Today, not my day.
Yeah, you're gonna have to.
I'll get it. I'll get it tomorrow.
Yeah. Yeah. Yes.
I just need to sit and say, I have
Yeah.
never sat with this before.
There's the answer.
There we go. So you made me do all that working and the answer point there.
Yeah. Okay, because that's the next step. It's to use the normal distribution table. Okay, but before I do that, I need to get the D. Okay. Yes, D2. Okay, I've got the D1. I need the D2. I need the other D. Okay, so if I look at the formula, which is here, you need D1 first before you can work out D2. All right, so that one isn't so bad to work out as long as you've got the right answer. Yeah, that's right. Okay, that's the answer over here as well. Okay. All right, good. Okay, so now you've got those two variables. Okay, I need an n, remember? Okay, so how do I get the n? The n will be for the d1 and the d2. Okay, so go to page 243, and now you need to look for the correct variable. So what is your z variable here? 0.4135. It doesn't go to that many. So you would, what would your value be? Yeah, so which one am I looking at? Yeah, 0.41.
It's closer to 4, so 0.4.
No, it'll be 0.41. Okay, so if I look at the x, I go down the left column and I look for x, 0.4, and then I go across to 0.01. And what value do I get? Yes, okay, and then you would do the same thing for the other one. No, yeah, 0.20. Yeah, 20. So 20 is the 0.5793. Okay. Right, so that's all you're going to have to do with that table. It's just, can you read off a figure from the normal distribution table? Right, so do we have enough information to work out the call? Yes, so what is the equation for the call? Yes, so what is the spot? We had it earlier? Yes. Okay, so yeah, on the next slide, I've given you some space just to put that in. Okay, substitute everything that you've got now into that formula and then calculate and solve. Yeah, you're going to have to use the E button on the scientific. The E should be close to the lin. It might be a second function on the lin even. Or it might be at the bottom. E to the X. Is it a second function? Okay, second function E. Right, then when you just press it, second function E, do you see a bracket? Exponent? Okay, so then you need to put a bracket and put all of that in. Okay, all of this needs to go in. Okay, so try it and see what you get. What is the value of the call? Value of the call would be? Yes. Yeah, it's the risk-free RC, continuously compounded though. Yeah, you can do it in as many steps as you like. It's fine as long as you get to the right answer. That's great. I didn't put the answers up here. Should have. Okay, let me type them out then. I don't have the calculator here. Let's see. Excel. No, can I borrow yours then quickly? Just to type that in.
What was the answer? 7 point?
Sorry, I pressed
okay.
clear. Okay.
The 7 point something.
Can I press the arrows up and down? Will it come back to? No, it doesn't. Okay, I thought maybe that would work. Okay, so let's check what this is. 68. Yeah, let's see what we get here. No, 11.77. 11.77. Okay, 11,77. Yeah, I'll check this next week with my calculator just to make sure it is 11.6 because I've done it on yours. It should be correct based on your calculator. Let's just check the brackets. I have the brackets there and everything. Yeah, that should be right. 11.77. Okay. Okay, maybe redo it now that we've got that. Okay, let me quickly do the next one. While I've got the formula up here, so I need to delete that.
And you entered one big drop.
Yeah, just one amount. Okay. Alright, so I need to change, this will be 65. Okay, no, your answer is actually correct. I just redid it to check it. I am getting 7.94. Yeah, 7.945042281. Okay, that's for C. Okay, so then let's check the put. Okay, the put here is, let's have a look. Okay, so I've got the 65. Okay, let's move this around. Okay, so 65. Okay, delete. Okay, so I need the 65. Okay, there's 65. 65e minus 0.04 times that. Okay, that all stays. Okay, delete that bit. Close brackets. Right, that's fine. Okay, so now I need to times this by, times that by 1 minus, bracket 1 minus 0.5793, close brackets. Then minus, open brackets, 68.5 times, bracket 1 minus 0.6591, close bracket, equals, okay, this is 3.666. Okay, so then the put here, P equals 3,666,184,554. Okay, so maybe you do that one on the calculator your way, and let's confirm if we get the same answer for P. Yeah, just work carefully and see if we get it. If you also get it, then it must be right.
Okay, I've got a couple of decimals, 29, 29.8, and I'm doing 1.5.
Okay, alright, so that's fine. At least we've got the right answer for that one as well. Okay. Alright, so that was continuous, looking at Black-Scholes Merton. Okay. The last few notes over here is looking at some considerations in terms of delta. Okay, so what is delta? This we actually looked at in 2601. Okay, change in option price divided by the change in underlying. Okay, RE, not RE, RC is the risk-free continuous rate, which you can convert, okay, to normal. Okay, yes. Right, theta and vega. Okay, what do they represent? They represent measures, i.e. like rho. Okay, rho is a measure, theta is a measure, vega is a measure. Okay, time to expiration and option price, volatility and option price. Okay, then you've got a note here about formulas for futures and forwards. Okay, we know we need to apply what? Putcall parity. Or you can use this. Okay, that's also something that you would use when pricing forward and futures contracts looking at options. Okay, so these are options on forwards and futures. Okay, options on forwards and futures. So it's a derivative of a derivative. Okay. Alright, and then you've got the black model, which is pricing European options on futures. Same thing applies. First work out the D, then substitute it in, and then get the C and the P. Yes, it is. It is very similar, yeah. Okay. Is it the same? Well, let's have a look at the ones you had here. No, yeah, it's F0. Yeah, it is a little bit different, yeah. Okay. Yes, okay, and that covers the options. Alright, so next week we'll look at the last chapter, and that covers the theory. Okay, then we just need to look at more and more questions if we can. Okay. Alright, so assignment 2. Okay, the swap questions we'll skip. We'll do everything else. Okay, do the questions change when you log on for the second time? Okay, because you've given us a set of questions to do, but is that randomized or is it?
I don't think
is it like your question bank and then?
I don't think so.
You don't think so? Okay.
The reason I don't think so is because remember everyone has to do assignment 2, so how can I give everyone different questions?
Well, they can all give them similar questions from a question bank.
What I see on the discussion forum from prior time.
It's all the same.
It's the same. Or
Okay.
you can change the options around.
Okay, then that's fine then.
It seems like that's the only thing they said. But I could be wrong. If you get Francine phone call going, I'm going to different.
Okay. Okay, but we can still discuss it next week. So you'll have this. You can try it during this week, and then next week we still have a lecture before the due date.
That's the thing. So when I submit it, I'm going to rework these questions again, and then I'll see if it's changing.
Yeah.
Then I know. That's not going to work.
Yes. Okay. So have a look at this one. Okay, you don't know what a swap is yet. Okay, so let me again refer to the textbook, or maybe you do because you've done risk. Yes. Okay, so if you look at the swap definition in the glossary, they'll tell you exactly what it is. The swap on page 641 is an agreement between two parties to exchange a series of future cash flows. So I'm swapping everything. I'm swapping future cash flows. All right, so which option is best here? A swap. A right but not an obligation. That's an option.
Yeah, let's go. That's out.
Yeah. A series of forward contracts. Question 1. No, an exchange. Yeah, future cash flows. That's right. Future cash flows. An exchange for one asset for another. A series of forward contracts. Yes, D. Like I didn't put D here, but swap. Yeah, swap is exchange. D. Because forwards are future contracts. Yeah. Okay. Future cash flows. Yes. Okay. Number 2. What is the focus here? It's a theory question. Yes, and this is looking at FRA. So FRAs we did do. Okay, so the company should take a long position. Is that true or false? Yes, true or false? Short or long? Okay, yes, so what should they do? Should they take a long position? You're saying yes. Okay, remember, what is a FRA? Correct. Okay, let's go to the formula just to show that. FRA, forward rate agreement, page 34. This is an interest rate forward, so page, 34. That's what I've got in the index. Okay, page 34. You should have the FRAs there. Let's open that up. Okay, there's the FRAs. Alright, so remember, in terms of the valuation for FRA, an FRA is a forward contract that's going to be based on an underlying rate. Okay, and if the forward rate agreement is going to be discounted, what happens? So if the rate decreases, the formula for FRA, the valuation, where is that? Okay, let me use my notes rather, it's easier. Did you find it? Oh, okay. That page. This was, okay, on page 33 is the discount interest, and that page is notional principal. Okay, that's the FRA. Okay, I just want to open up my notes. Which week was this in? Do you remember? Forwards. 2. Yeah. Where is the FRA? There's the FRA. That's the spots. That's the forward. Okay, yeah, so that's the right one. Okay, yeah, so that's the FRA. So underlying rate at expiration. Okay, so what rate do I have here? I have, this was a 90-day, based on 90-day LIBOR. The quoted FRA is 6.5. The LIBOR at expiration is 5. Okay, so that would have been 5. So if I'm looking at underlying rate at expiration, it's 5%. The forward rate is 6.5%. Okay, this is looking at going long. Okay, because for a party going long, they will benefit if the rate rises. Okay, so this is a short then, because the rate has fallen. Okay, so it must be a short. What did I have? Yes. Okay, so false, short position. Right? You could even look at some of the calculations on page 55. I put a note here, page 55 as well. There's the FRA long and short rates. Okay. Right. Question B3. Question 3. What accurately describes a derivative? Correct. Okay, B. 4. Which one are you going with? Yes, good. Right. Number 5. Okay, good. Okay. 5. Yes. Okay, so what are they asking for here? The payoff. Yes. Correct. Okay, so you write down the formula
So,
and then you substitute and solve. 55.
I'm going to have the 35.
55. 55. This was, what was this? This was a interest rate forward. Interest rate forward. Yeah, it's an interest rate forward, not a bond forward or a LIBOR. Yeah. Okay, it's an interest rate forward, so 55. See, you just need to know what is being asked. That's all. Okay, because you can't use that formula, you must use this formula.
And that's that F, this is
That's, yeah, that's this one over here. So I drew a diagram. This is the little picture. Okay, I'll send this to you so you've got it, but there's the picture. I'm looking at GH and I'm solving for the V, yes. Okay, so what happens here? Rates are expected to decrease. Okay, so it's quite a long calculation, but you do need to identify what the L0 is H, what the LGH minus G is, and what the H plus M minus G is. Okay, so I've just pulled out the information from the question, substituted everything in and solved, and we'll have to do the solving just now. We have to type that into the calculator. What? The what? The 0.05 is the LIBOR at expiration. Okay. G is the days later. Okay.
The H is the expiration of the...
Yes, the H is the expiration.
So that is
180 days. Yeah.
The M...
Yes, the M would be the maturity, which is 180 days as well. So that didn't change.
So that's the...
That's maturity. M is the time to maturity. Okay. Yeah, which would have been 0 basically. Okay, because the underlying, the maturity is the same as the G is 0 days because you're at expiration. G would be 180 actually. H minus G would be 0 days. There's it. Have a look. G is 180 days because it's how many days later?
180 days.
Yes. Okay. Alright, and then on the calculator, let's type all of this in. What does that equal? H was 180, yeah. Okay. Alright, so let's see. Equals bracket minus bracket. Okay, in this bracket, 1 divided by open brackets 1 plus 0,05 times by 0 is 0, so that would be 1 plus 0 is 0, so it'll be a 1, and then, no, it's fine, bracket 1 plus 0,065, bracket 180 divided by 360, close bracket, divide by open bracket 1 plus 0.05 open bracket 180 divided by 360, not 365, 360, close bracket, enter. Okay, there we go. Okay, so that's what that adds up to after having put all of that in. So that was the value of the FRA. So the notional principal, did they ask for that here? I think they did. The payoff, expected to receive a cash inflow of that. Okay, but what is the notional principal? Okay, so if I times this by, how do you know it's a million? Where is it? Okay, that's the expectation, for that particular, that would be, let's have a look. Determine the payment. Yeah, we could assume that. Yeah, you could assume 1 million. Okay, so if I assume 1 million times this by 1 million gives me a loss or a negative. So equals this times 1 million. How many zeros is that? 3, 4, 5, 6. Okay, it gives you that. Yeah, a loss, negative.
When you say payoff, then you want the actual contract you're going to do, right?
It means at expiration, yeah.
So I'm assuming that they want,
Because at the end it'll have 1 million. Yeah.
payoff there, so
Yes. Okay. Right. Is that one okay?
yeah, that makes sense.
Okay. Next one. What's the focus here? Yeah, it's the future price, right? So it's the spot price taken forward minus the future value of the dividends.
And they went in the stock index, so they want
Yes, they wanted the S0, the spot, exactly. Okay, so I took the formula, I substituted in those amounts, and okay, again, let's work out the answer here. So this will be to the power. Okay, this I am going to need the calculator. Okay, maybe you do it, and then I'll do it afterwards. Okay, just to check. Let me see if I can do it here. This is 1,800 divided by open brackets 1 plus 0,075. Okay, I need the power button. See, I need a power though. Well, I'm not too sure how to do the power here. Let's see. Exponents equal exponents. Returns e raised to a power. Returns c power. Returns the result a series yes, a number raised to a power. Okay, so brackets. What is the number? 1,075. The power is 3 divided by 12. 3 divided by 12, close brackets, close brackets. Okay, so that's what I get there. So spot would be equal to 1,800 divide by, before I divide, I need to subtract. So brackets, 1,800 plus 8 Rand 25, close brackets, divide by that answer there. So what did you get? Yes, 85. Okay, how did you get that?
It's just a
Rounding.
I think.
Okay, but here, 1775,85.
No, but 1,775. So I think it's just a rounding.
Yes, okay.
So I think it's like this.
Okay. Pardon? No, you're not. The lecture only starts at 5, yeah. Next lecture only starts at 5, so don't stress. Okay. Just be careful, the scientific calculator is better than the financial.
I'll try now
The other one.
the scientific.
Yeah, oh, you're not using the scientific, so let me use the scientific then.
I use I use my old Facebook.
No, you're using that one. That's why the rounding is a bit different. Okay, so if I use this calculator and I put in the 1800 minus the plus, actually, plus 8.25, close brackets, divide by open brackets, 1.075, okay, to the power 3 over 12. Close bracket equals, yeah, 1775.85. That was right. Okay. Save. I don't know. Looking at what they've asked you here, they didn't give you a multiple choice here, so you have to type in the amount. So maybe, okay, that's going to be quite unfair if you, let's say, 2 cents out and they mark it wrong. I don't know how they're going to do that. I would have given a multiple choice here if I was Unisa. Yeah.
And how many decimals?
They don't say. That's the problem. Okay, they just want the final answer. So.
It's not, but I work my whole calculation on 2 decimals. I'll be completely different to 4 decimals.
Sure.
And they don't actually say any.
They don't. They don't. Yeah, they don't. Okay. Okay. Is that right? Okay, 7. It's discounting, yeah, treasury bill. So if you're discounting a treasury bill, that's the principal minus the discount interest. Well, if you do you get this answer? Try. You should be getting 9774. If you do, then great. If you don't, no. $9774. No, okay, 9774,87. It's discount interest. Yeah, it's discount interest. So it's 1 minus the rate, discounted for 165 days. Okay, it gives you the discount interest. If I subtract that from the principal, I'm going to get the treasury bill. Okay. All right. Then question 8. Question 8 requires a table. Okay, so I haven't had a chance to download those rates because we'll need those rates to do it. Okay, we need to download this RMB sheet to get the rates, and you need 2 rates. I've put a reference here, covered interest arbitrage, page 59. Okay, have a look at example 60. Okay, and we need that separate RMB information. Okay, so I haven't done that yet because I haven't downloaded this link. Okay, I need to download that link. Okay, so if I'm looking at the Rand risk-free rate and I'm looking at the Euro risk-free rate, I need the exchange. Okay, because it's the foreign currency and the local currency. Okay, for the arbitrage profit, yeah. Okay. Okay, so yeah, that one I will go through next week I will download the sheet and we'll look at the interest rates, okay, the changes. Okay, number 19 we should be able to do. Let's have a look. Number 9 actually, last one here. Okay, what is number 9's focus? Okay, so if it's a future, what do I need to do? Which formula do I need? What type of future? Okay, so yes, okay, so I'm going to have to first work out the price, okay, and then work out the futures price. All right, compounding it. So the compound the 12150 to expiration, and I then get the 138.70. Okay, so first see if you can work out the bond price. Okay, you need a timeline, so that's my timeline. No, they don't. Oh, yes, they did. Yeah, the 2124 is there. Okay. Yeah, so that actually you didn't have to work that out. It was given. Okay. Yeah, you could. Yes. Okay, and then they've given you the 18 months. There's the risk-free. The payment was given, right? Yes or no? Yes. Semi-annual coupons. Okay, and future value would be 100, assumed 100, because par was at a premium, trading at a premium. Okay, so you have to work out the futures price. So I need to take this amount and I need to compound it forward. Okay, remember, to work out a future, it's based on what something is worth today. So if I take this amount and I compound it to, so that you can do on your calculator. This is at expiration. So where is expiration? T 18 months, yes. And then you should get the 138.70. Time value of money. Taken forward 18 months at a rate of 4.5%. Risk-free rate. The risk-free is 4.5. 18 months is 1.5 years. No coupon. Yes, you've got a price that represents all the future cash flows. Do you get 120? Let's double check. Future value, FV.
Okay, 121.543.
Yes.
Okay, 0 payments, 1.5.
Oh, right. Okay, I've used 3 years here because it was 3 half years. What was the rate? It was risk-free. And this was semi-annual. So if I use the 4.5%, I'm going to need to put brackets 18 divided by 12. Close brackets. That gives me, yes, 129.84. That's correct. Yeah, what you had was right. Okay. Is that all right? Great. 84. Okay, so next week we can look at that one question, number 8, and then maybe if you want to, maybe send me assignment 3's workings, and we can even start with that next week as well. Okay. Yeah, and then just send it to me again like we did, like you did. Yeah. Well, we might or might not be able to do it next week because we still have one set of notes to get through. Okay, so we'll go through that one question, and then we'll do the swaps, and if there's time, then we'll cover the next bit as well. Yeah.
And I definitely, you don't know what all this means, this,
what means?
Characters.
Oh, this is how you should enter your answer.
It makes it absolutely.
Yeah, so you should enter answers as a negative. Okay.
Minus.
Yeah. So for example, remember we had the one which was a negative 7,000 something. So you have to put minus 7,000. Just be careful you don't put a comma instead of a point. I don't know what they want here. Actually, that's a bit too small.
They just say Esteban separated by.
For scientific notation, use the decimal point marker. Okay, there was no scientific notation, so you don't have to put that in. Okay, that's for formulas if you had to put in formulas. Yeah, that's just the input. That's how they want you to put this in, so the computer will save your answer and it'll know what the input is. Yeah.
So I'm just not going to put any comments. I'm not going to have a thousand separator. I'm just going to go with that.
Yeah, you won't need a separator.
I'd love to know how many decimals they want us to calculate.
Yeah, that we don't know. Okay.
Maybe what I should do is to make a problem.
Do the discussion forum maybe.
Or maybe the discussion.
Yeah, that could probably be quicker.
Because I don't know if any decimals.
Yeah. Well, hopefully they're just going to look at the answer. I don't know how many students are writing this module. I don't think too many. It's not a popular one, but maybe the lecturer will actually get the answers and then mark it electronically, I guess. Okay.
Or maybe that's why.
Possibly, yeah.
I understand fully that it's not.
It's not that bad actually. Oh, you're not enjoying it, but it's not that bad actually. It's theory.
It's not theory.
The calculations aren't so hectic. It's just formulas. You just plug it in and you work it out.
Just reminds me of equity.
Oh, you don't like that module.